So, let's talk about something that feels complicated but is actually, at its core, pretty simple. Insurance. Imagine you're walking down the street. The sun is shining, the birds are singing. Everything is great. But just know that at some point, it might rain. Not today, maybe not tomorrow, but eventually. You could just hope for the best, or you could carry an umbrella. Insurance is that umbrella. It's a tool you have before the storm hits, not something you scramble to find while you're already getting soaked. It's a plan for the unexpected, a safety net for when life decides to throw a curveball, a banana peel, a torrential downpour. The world is full of what-ifs. What if you get into a car accident? What if a pipe bursts and floods your kitchen? What if you get sick and need expensive medical care? These are scary thoughts because they represent not just personal hardship, but also a massive, potentially devastating financial cost. Insurance is a system designed to manage that risk, a way for a large group to pool resources to help the unlucky few. Okay, so we've established insurance is like a giant protective club, a club for people who want to avoid financial disaster. But how do you become a member of this club? You can't just show up and declare yourself protected. You need a ticket. You need a membership card. That ticket, that membership fee, is called a premium. The premium is the specific amount of money you agree to pay on a regular schedule, usually monthly, quarterly, annually, to the insurance company. In exchange for your payment, the company agrees to cover certain financial losses as outlined in your policy, the fancy name for your membership agreement. So the premium is your contribution to that big pot of money. It's the key that unlocks the door to protection. Without paying it, you're on the outside looking in, hoping the rain never comes. It's a simple transaction. You give the insurance company a relatively small, predictable amount of money regularly. They give you a legally binding promise to pay out a much larger, potentially astronomical sum if something bad and unexpected happens. In our modern world, we are all incredibly familiar with subscriptions. You probably have a subscription to a streaming service for movies, a music app, or maybe even a meal kit delivery box. You pay a set amount each month, and in return, you get access to a library of content or a box of fresh ingredients. An insurance premium works in almost the exact same way. It is, for all intents and purposes, a subscription for financial security. You pay your monthly fee, and instead of getting to binge watch the latest hit show, you get the assurance that you're covered if your car gets stolen or you need an emergency surgery. This subscription model makes managing the cost of protection much easier. Imagine if you had to pay for your entire year of car insurance in one giant lump sum. For many people, that would be a huge financial burden. By breaking it down into smaller, regular premium payments, it becomes a predictable part of your monthly budget, just like your rent, your utility bill, or your phone plan. You know it's coming, you know how much it will be, and you can plan for it. This predictability is a huge benefit, turning a potentially massive financial concept into a manageable, bite-sized expense. Let's stick with the streaming service analogy. When you pay for your subscription, you might not watch a movie every single day. Some months you might watch a ton, and other months you might be too busy to watch anything at all. But you keep the subscription active because you want the option to watch something whenever you feel like it. The value is in the access. It's the same with insurance. So, if everyone pays a premium, does everyone pay the same amount? Absolutely not. This is where it gets a little more personal. Insurance companies are in the business of managing risk. To do that, they figure out how risky each person or asset is. This process is called underwriting. Think of it as the insurer doing homework on you. They gather information to predict how likely you are to file a claim. More perceived risk equals a higher premium. It's a simple equation. Let's use car insurance. How old are you? Very young drivers have more accidents. A 17-year-old versus a 45-year-old with a clean record. What kind of car do you drive? Flashy sports cars cost more to repair or replace than sensible sedans. Where do you live? Urban areas with traffic and theft are riskier than quiet rural towns. Driving history matters. Speeding tickets signal risky behavior. Same logic for other insurance types. For health insurance, they'll consider your age and current health status. They look at your current health status. Whether you smoke, sometimes your family medical history. For home insurance, they check the age and construction of your house. Is the location flood-prone? Is it wildfire-prone? Do you have safety features like smoke detectors or a security system? Each factor helps them build a risk profile. Ultimately, insurers aim for fairness. They want premiums that reflect your level of risk to the collective pool. Someone more likely to take money out of the pot pays more in. Be honest on your insurance applications. Okay, let's bring this out of the theoretical and into your everyday life. You encounter premiums or the need for them all the time. The most common example is car insurance. In most places, it's legally required to drive a car. You pay a premium, perhaps $150 a month, to an insurance company. If you get into an accident and it's your fault, the insurance company will step in to pay for the repairs to the other person's car and their medical bills, up to your policy limits. Without it, you would be personally responsible for those costs, which could easily run into tens or even hundreds of thousands of dollars. Your premium is the small price for avoiding that catastrophe. Then there's health insurance, which is honestly a huge topic in many countries. Let's say you pay a $400 monthly premium for your health plan. That feels like a lot of money every month, especially when you're healthy. But then you fall and break your leg. The ambulance ride, the emergency room visit, the surgery to set the bone, the hospital stay, the surgery, and the follow-up physical therapy could cost over $50,000. Because you've been faithfully paying your premium, your insurance will cover the vast majority of that bill. You might only be responsible for a smaller amount, called a deductible or copay. Homeowners insurance is another classic example. Renters insurance is another classic example. You might pay a premium of, say, $50 a month to protect your apartment or house. One night, a kitchen fire breaks out, causing significant smoke and water damage. Your insurance policy, kept active by your premium payments, helps you rebuild and return home. So, what happens if you just stop paying? Maybe money gets tight. Or maybe you just forget. This isn't like forgetting to pay your streaming service. The worst outcome is missing a new movie. When you stop paying your insurance premium, you trigger a specific series of events. They can have very serious consequences. The first thing that will happen is a notice from the insurer. They'll tell you your payment is late and that your coverage is in jeopardy. Most policies have what's called a grace period. It's a short window of time, maybe a few days or a few weeks, during which you can make the late payment without losing coverage. If you don't pay within that grace period, your policy will lapse. That means you are no longer insured. You have no protection. If you get into a car accident the day after your policy lapses, you are completely on your own financially. The insurance company has no obligation to help you. You've effectively been kicked out of the protection club. For car insurance, driving without it is illegal in most places. You could face fines, license suspension, or impoundment. If you try to get new insurance later, insurers will see the lapse and label you higher risk. As a result, your new premium will likely be much more expensive. This is why paying your premium on time is critical. Set up automatic payments, mark it on your calendar, and treat it with the same importance as your rent or mortgage. Let's zoom out for a second. Look at the whole system. Why are premiums so fundamental to the entire concept of insurance? It's because they are the fuel that powers the engine. Insurance companies are not magical entities with infinite money. They are financial institutions that operate on a simple principle. They must collect enough money in premiums from all their customers to cover the claims made by some of their customers and also to cover their own operating costs. They must pay out claims and keep offices running, paying employees and keeping the lights on. The money has to come from somewhere, and that somewhere is the premiums. Imagine a giant empty swimming pool labeled Claims Fund. Every person who buys a policy pours a bucket of water, their premium, into the pool each month. The pool starts to fill up. Now, throughout the month, a few of those people will have a bad day. One has a car crash, another has a house fire, a third needs surgery. They file a claim and the insurer removes a few large buckets of water from the pool to help them cover costs. The system only works if the small buckets poured in by everyone are, in total, enough to cover the large buckets taken out by the unlucky few. If too many people stop paying their premiums, the water level drops. If it drops too low, there might not be enough to help the next person with a legitimate claim. This is why consistent premium payments from everyone are essential. Your individual premium might seem small, but combined with millions of others, it creates the massive financial reserve needed to handle everything from fender benders to catastrophic disasters. When you pay your premium, you're participating in a community of risk sharing. Premiums are the lifeblood of insurance. Without them, the system would collapse, leaving everyone to face life's biggest risks alone. So, let's tie this all together. Why is paying that premium, that recurring fee, so fundamentally important? It comes down to a single word: promise. When you buy an insurance policy, you are making a promise to pay your premium regularly. In return, the insurance company makes a much larger promise to you: to be there with financial support in some of the worst moments of your life. Your premium is the key that keeps their promise active. If you break your promise, they are released from theirs. It's a two-way street, a contract built on mutual responsibility. Paying your premium is an act of foresight. It's a decision you make today to protect your future self. It's easy to look at the money leaving your account and think, what am I even getting for this? I haven't had an accident in years. But you're not paying for something that happened in the past. You're paying for what could happen in the future. It's an investment in resilience. It's what allows a family to rebuild after a fire and allows an injured person to get medical care without going bankrupt. It lets a driver responsibly handle the aftermath of an accident. Think about the alternative. Without insurance, every risk is yours and yours alone. Paying a predictable premium is a strategic choice to avoid unpredictable financial chaos. It's about maintaining control over your financial life and protecting your family and community. So, as we wrap up, let's think about the mood. Perhaps some thoughtful, optimistic background music would be fitting here. Something calm and empowering. A premium isn't just a random bill. It's your deliberate, proactive step toward building a wall of financial defense. It's your subscription fee for security. Your ticket to a club of mutual protection. Your contribution keeps a collective pot ready to help people when they need it most. We've seen it like an umbrella, a subscription, and a community fund. Paying that premium turns a piece of paper into a powerful shield. It activates the promise so when the unexpected happens, you won't face the financial fallout alone. It's a small, consistent action with a massive potential payoff. Paying your premium is one of the smartest investments you can make in your future.